commerce and credit and trade and bank balance sheets are so high, we don't have enough gold to support that level of commerce. We just don't have enough gold. That's nonsense. There's always enough gold. It's just a question of price. Now, at $1,800 an ounce, no. If you say we're going to go on a gold standard at $1,800 an ounce, and here's how much gold we have, you'd have to cut the money supply by about 75%. And that would throw us into, that would be the Great Depression. That would be, you collapse the economy. You can't do that. By the way, it is the mistake that the UK and Winston Churchill made in 1925 when they went back to a gold standard at the pre-World War I rate. And that was basically overvaluing sterling. So they had to cut the money supply, and they did go into a depression 4 years ahead of the rest of the world. So hopefully lesson learned, although with central bankers, you never know. So if you say, okay, if I want a gold standard, I can't peg it at 1,800 because I'd have to cut the money supply by 3/4 or more. So what's the alternative? Raise the price of gold. So notice the same amount of gold can support any amount of commerce at a higher price. So then the question is just an 8th grade math problem. It's like, okay, well, what would the price have to be to match the money supply? And use M1 as an example. Historically, 20% is worth, so I'll be conservative and say 40%. So if you take 40% of the money supply, and that's how much gold you need by value, and we know the weight, divide one by the other, and you come out to $15,000 an ounce. So the reason I'm explaining that, Robert, is I want to be clear that there's not a central bank in the world who wants a gold standard. They're not going to go to it voluntarily. Correct. But if they have to, because of collapsing confidence in the dollar, then it follows that you have to go to $15,000 an ounce, because any lower valuation is deflationary, and that's the last thing you want. And inflation has been running hot since last spring, since April, May of 2021. And some of the monthly numbers have come in, whether it's the producer price index, PPI or CPI. They're printing numbers that are the highest in 30 years or sometimes longer. So we're going back to, if not the worst of the 70s, at least the early 1980s, but in some cases longer, for these inflation numbers. So inflation is showing up. So that's undeniable. You can argue about the forecast, but it's here. Well, if you say, okay, April, May, June 2021 were hot. Well, what was going on in April, May, June of 2020? Because that was the comparison. Well, the economy has shut down. I mean, literally shut down. The worst collapse since 1946. And one of the worst in American history. So we didn't just have low inflation in 2020. We had deflation. Prices were going down. So when you get to 2021, the year-over-year comparison, of course it was going to go up. Of course that was going to be more than usual. That was completely expected. It's hard to disentangle what I just described as the base effect from it's called real inflation, real price increases. But the best estimates were about half of it was a base effect. So if you were seeing a number of 6% inflation, that was about what it was. You could say, well, it's kind of 3 real and 3 base effects because we're comparing to a very weak year. However, as you got into August, September, October, the base effects started to go away, which is, you say, well, what was going on in August, September, October 2020? Well, that was one of the strongest periods of growth in U.S. history. That was the other side. It went down and then it came back up. It didn't make it all the way back up. But yeah, that was a strong rebound in the third quarter of 2020. So you would expect, so therefore the base effects went away. But the inflation remained hot. It didn't fade as much as I thought it would. It was like, okay, well, the base effects are gone, but the inflation is still there. In fact, by some measures, it's even worse.